some concern that the rand could strengthen even further from these levels if it does breach and hold below that 660 mark. What's your view on the rand going forward from here?
Well, as you say, the rand is super strong at the moment. On our valuations, probably at least 20% overvalued at the moment, which is pretty much near record levels. And as you say, right through this holiday season, we had continued rand strength, not only against the dollar cross, but most particularly against the euro. So our export sector is going to be battling with the strong rand. But what is interesting is that exports from South Africa continue to pick up, not just in value terms because of the rise in the commodity prices that you guys were talking about, but also in volume terms. So the growth in the global economy has been enough to offset the negative impact, at least so far, from the very strong rand on our export sector.
Well, we had that trade balance coming in for November, 8.4 billion rand, probably surprising a little bit to the upside, and that was despite the rand strength during that month, as you said. Yes,
we've had very good trade figures in general. The current account numbers likewise have been very good, but we shouldn't overemphasize that because of the pickup in the domestic demand, consumer growth coming through, the rise in investment spending, the trade balance should start to worsen from here. So we've probably already passed the best from the current account deficit. And the strong rand will essentially drive the current account deficit worse, implying a need for foreign funding. That is essentially what brings everything back into balance eventually. But that's potentially still a long way off. If we look back to the last cycle, it was when we had a current account deficit of worse than 6% that the rand started to come under pressure. Current account balance at the moment is just over 3%. So probably another year at least before those imbalances really start to impact on the rand.
Andrew, some would argue that one of the other drivers of the rand last week might have been the announcement that South Africa had been invited to join the BRIC group of nations. Would you see that as a big positive for South Africa and for the rand?
I wouldn't. There may be a short-term psychological bounce, but I can't see that there's any sort of institutional benefit, if you like, from being a member of the BRIC countries. I don't think anybody makes the decision based on whether we belong to that association or not. It's not like an investment rating. You know? So I wouldn't have thought beyond, sort of kudos that go with being associated with successful BRIC countries. I can't see it being a long-term, lasting effect at all.
What's your view on that, John? Any benefits for South Africa?
Well, I completely agree with Andrew. And also we must just go back to the original news story. It's not that South Africa was invited to join the BRIC meeting as a ex-numerary, as a invited guest, not really as part of the major four. As Jim O'Neill, who originally wrote the BRIC research, said, South Africa is just far too small to be included in the BRICS. Our population size, our potential economy size. We're not in that league at all. We're really down the list of potential investment plays.
Other potential drivers that might have pushed the rand to those levels last week, I assume it was thin holiday trade as well, and we did have the the dollar coming under pressure against the euro.
Well, speaking to my dealers and traders at Rand Merchant Bank, they're telling me that the flows were actually fairly good. Also, interestingly, from the import side. So a lot of exporters obviously pushing the rand stronger, but the importers coming in and reacting. The drivers probably, obviously, the weak dollar story, commodity prices rising very aggressively, but general risk on story. That's it. You've seen the Dow up repeatedly over the past couple of weeks. And if you look at the other currencies out there, the Aussie dollar, the Kiwi dollar, Canadian dollar, all the commodity currencies generally doing well. So it's not a rand story. It's once again a global phenomenon.
What's your outlook on commodity prices, Andrew? We had China raising interest rates on Christmas Day by 25 basis points. Their PMI numbers coming out over the weekend, a little bit worse than expected. So that economy starting to slow slightly, it would appear, though deliberately so.
Yeah.
Do you think this could affect commodity prices going into the new year?
Well, it goes to the point that I was making a couple of minutes ago, is that we are dependent on them actually calibrating these policy moves very carefully. If they make a mistake, and the markets take fright, or we have a commodity supply-demand imbalance, or what have you, we're in trouble, because everything appears to be predicated on the fact that the Chinese will continue to absorb a vast majority of the available resources that are available, and pull the rest of Asia with it. If we manage to get through 2011 and they don't make any policy missteps, well then we're going to have a very good year. But the odds must be rising in terms of the possible risks that are associated with them raising interest rates in order to certainly dampen what are quite strong inflationary pressures in China, and at the same time not giving the commodity and the related markets a scare.
Do you think that the Chinese have been careful enough with those monetary policy steps, perhaps by raising them on Christmas Day when most markets are closed and you have time to think about it before you react?
Yes, I mean, they've certainly been very cautious in their policy response, first raising the reserve requirements, now 2 interest rate hikes. But I'd agree with Andrew that the whole China story is a major risk to the South African economy and the South African markets, including equities and the rand. If China tightens too fast, as Andrew says, you could dampen the demand for commodities that would feed directly through into South Africa. That's probably one of the 3 big potential risks for the markets this year. Alongside that, I'd probably put the pigs in Europe. We've heard that story repeatedly, but it's not going away. And thirdly, then the possible tightening of policy in the US. Now, that's still a long way away, but the market will preempt that. And I don't think that's a story for 2011, maybe just towards the end of 2011, already seen some weakness in US bonds on those type of concerns. If US bond yields push up on the expectation of monetary tightening in the US, then you could start seeing some of the money that went to emerging markets starting to reverse, in other words, implying rand weakness, probably some sell-off in our domestic equities as well.
Well, see, Estonia today became the 17th member of the Eurozone. I don't think it's a very good time perhaps to join. The pigs, though, seem to have died down over the past couple of weeks, but they haven't gone away, have they?
No, they certainly haven't. Greece, certainly yields are ticking up all the time. There's high volatility. I mean, those yields are up and down sort of 20, 30 points every single day. And the issues have not gone away. And I've said quite a few times when I've been on programs like this, it's all about the Europeans, the weaker Europeans, or the market wanting weaker Europeans to attach the German balance sheet. As soon as the Germans give carte blanche and give protection to the peripherals, then the market would be happy. But you can understand the Germans stepping back from it and saying, we've been through 20 years of that with East Germany. We don't want to be funding the Greeks and the Portuguese and the Spaniards and the Irish. The problem for the Eurozone, as John was talking about, and I agree with him in terms of being one of the really serious risks for 2011, is that it is at the moment a sovereign risk problem. But the owners of those bonds are the German, the Austrian, and the French and the British banks. And they can't afford, so soon after 2008, to take another massive hit to the balance sheet. So it's a very, very difficult problem for the European authorities to try and cauterize this problem and to provide reassurance for the market, at the same time trying to provide the peripheral countries with acceptable funding rates that's not going to tip them into a very, very deep recession, without committing exorbitant amounts of capital to the problem. So it's going to be a very, very tricky issue, and I think the markets are going to really push the authorities, both fiscal and the ECB, to try and find a sort of binding resolution, if you like, over the next 6 months.
Do you think this is something they can navigate through safely, John?
I think it's going to be very tough, but we must think about the size of the economies that we're talking about. If you're talking about Greece or Portugal and Ireland, each of those economies are more or less the same size as South Africa, a little larger, which is to say very small in relation to the total Eurozone, approximately 2.5% of Eurozone GDP. So pretty small. When we're speaking about Spain or Italy, then we're into a completely different realm altogether. Spain is the 10th largest economy in the world. If Spain gets into the same type of problems as Greece or Ireland did, then we are going to be in for a serious run in the financial markets. That, at this stage, is probably still a low probability event. But as Andrew said with the China story, those risks are growing all the time. And we have to be very well aware of those. Just to put it in perspective, you've got Portugal, Ireland and Greece. Spain is more than twice the size of those 3 economies put together. So Spain is really probably the key one to watch. There's also been some concerns about Italy and increasingly about Belgium. But for now, the focus is on Spain. It looks like they can get through their trouble, but we could be in for a rough ride if things change there.
Andrew, John mentioned monetary tightening as a potential risk much further into the future in the United States. I'm sure that must depend really on jobs data and creating employment in that economy. We're getting non-farm payrolls numbers at the end of this week. The previous reading, I think, for October was pretty dismal. Do you think we're going to start to see that any improvement coming through on that front?
Well, we saw just before Christmas first-time claims below the 400,000 mark for the first time, whereas, however, continuing claims were marked higher and the revisions from the prior week were higher. So I'm not sure. I think the unemployment problems in the United States are much longer lasting. I think that businesses are still very reticent to go out guns blazing and start hiring. So I think that remains an issue. But the bond market, notwithstanding that, has started to tighten for the Fed. So we've seen the 10-year bond go from, I think, 260 up to 330 in the last 6 to 8 weeks. So you could argue that tightening is starting to happen already, even if short-term rates are anchored at 25 basis points or 50 basis points. So it's going to be a very, very tricky situation where the Fed, you can see some governors who are now becoming voting members are very, very keen to step away from the excessively easy monetary policy and at least signal to the market that there are rate hikes along the road. But they need to be very, very careful. And the markets are still fragile.
John, could you even hazard a guess as to where the rand might end 2011 at this stage?
I think it will be strong. Strong against what is probably the bigger question than if it's going to be strong or weak, because you've got that trade-off between the euro and dollar. Which of those two are going to be the weaker currency? Our view at RMB is, given the weakness in the eurozone and the problems with the pigs, that it's probably going to be euro rand that's going to reflect most of the rand strength. But as we've spoken about today, looking towards the end of 2011, maybe there are some concerns creeping in. A year is a long time in the financial market, so the bias now is still for a strong rand, despite hefty Reserve Bank intervention. Maybe towards the end of this year, the trend could start to turn.